On Thursday, we got another jobless claims number. And while the number does look good, and while it does appear that the amount of jobless claims is going down, even though we have over 38 million adult Americans that have filed for jobless claims in the last 9 weeks, it is misleading. So I pulled out some additional research from the CNBC article with that chart before, that the continuing claims jobless number is growing still, and people are on unemployment for weeks, if not months, while the headline jobless claims number appears to be falling. So over 2.52 million Americans increased in only a week to the continuing jobless claims. Also coming up, we don't know how this is going to be settled. I'll talk about that in a second with the next slide. The SBA loans, or payroll protection program, are due to be forgiven, which means that the small businesses that took the SBA loans, in order for them to get forgiven to keep the employees on the payroll, they're going to have to decide soon what to do with the employees. Is there going to be an extension? Because the PPP program opened on April 3rd, and the 8-week loan forgiveness periods begin to expire at the end of next week and then in early June. Congress, the House of Representatives, and the senators have to figure this out. If they do not, the odds are very high that a lot of these small and medium-sized businesses will start to let more employees go. So even though the headlines jobless claims numbers are going down, this is a potential new rapid spike in the amount of people that would be filing for jobless claims, and the amount in the higher unemployment rate if this does happen and Congress does not fix this. And anyway, many Americans with their $1,200 stimulus checks are buying stocks, a lot of stocks. The amount of people day trading on Robinhood app and elsewhere is up. According to this, people earning between $35,000 and $75,000 annually trade stocks about 90% more than the week prior to receiving their stimulus check. And no wonder then, in addition to the intervention we have from central banks and governments to try to move asset prices back up, no wonder then that the S&P 500 is rallying so much. Look how much it has rallied since the lows towards the end of March, beginning of April. This is a slide of the NASDAQ. It has also rallied a lot since the beginning of April. The NASDAQ has actually rallied even more, as you can see on this chart, than the S&P 500. So why are these stock market indexes rallying so much? Now, I was kind of shocked to see the total number on this next chart. So this data was compiled by Cornerstone Macro, came out recently. When you combine the total amount of central bank liquidity injection with what governments have also done, as you can see here in this table, over $20 trillion in only a couple months. So that currency, that credit injection, those credit injections, currency, credit, emergency liquidity, it has to go somewhere. Are people going to hold it all in cash in their bank accounts? Probably not. So where do you think it's going to go? Probably to the stock market, as we can see by the price action with a lot of these stocks, especially US stocks, whether it's the S&P 500, the NASDAQ, and more on that in the charts and graphs that are coming up. This shows the Fed's balance sheet. Now, this is a little old. This is about a month old, but this shows the correlation between the Fed's balance sheet, or total assets, going up and the S&P 500 rallying. Now, the Fed's total balance sheet, the official balance sheet, we just got an update from that. I have the numbers here. The official total balance sheet is now over $7 trillion. It's at 7.037 trillion. So it is up since the end of August 2019, over $3.2 trillion up. That is an 87% increase in the Fed's official balance sheet since quantitative tightening ended early, I might add, at the end of August 2019. So an absolutely enormous increase in the Fed's official balance sheet. In just the last couple months, the Fed's official balance sheet is up well over $2 trillion. But since quantitative tightening ended at the end of August 2019, it is up over $3.277 trillion, or roughly 87%. And notice the correlation here in this chart with the Fed's total balance sheet and a rally in the S&P 500. This is another chart showing the US versus other stock markets. So the US stock market is even more, on a relative basis, overvalued compared to other stock markets in Europe and Japan. This chart shows that it is a disproportionate amount of companies that are driving the higher stock market moves. So out here on this chart, this is the S&P 500 market cap, but the amount of the stock market move is almost all concentrated, enormously concentrated in the FANGs. So, well, you got to add Microsoft in there, but Facebook, Amazon, Apple, Netflix, Google, and then Microsoft is also added into there. So it's not that many companies that are driving this. And that's because a lot of companies don't have cash flow, have bad balance sheet problems. The cash flow problem is real. But for some of these companies like Amazon, Microsoft, which sells software, Facebook, they're still getting sales, or well, Alphabet's Google, they're still getting sales. So that's my point. So a disproportionate amount of investors or speculators, flight capital coming into the US, and central bank liquidity injections are going into basically the FANGs, or only about 5 companies, according to this research. This shows that the FANGs, adding Microsoft in there, so FANGum is close enough, that the FANGum are drastically outperforming and a higher valuation than the S&P 500. So this shows just another similar chart to the chart before, that these valuations are much higher, a lot more capital is going into those handful of stocks. This is the Russell 2000 index chart. Now, the Russell 2000, if you're not familiar, is more of a wide range of companies. There's a lot more small caps in there and medium-sized companies. So it's more similar to businesses on Main Street. And this chart has not been doing well really since 2017 and 18. It's been very volatile, and it collapsed as well recently, but it has not rallied nearly as much as larger companies with the S&P 500 and the NASDAQ companies, especially the FANGs. So I think this is a better representation of Main Street, that even though it has rallied, it's nowhere near the levels of the other larger companies. And that's because these smaller companies are probably not getting nearly as much capital as the larger companies are getting. I doubt these smaller and medium-sized businesses are getting anywhere near the bailout money that these larger corporations are getting, especially when you have people like the U.S. Treasury Secretary, Steve Mnuchin, changing the rules for the different programs, PPP programs, the SBA loans, so larger companies can get access to them. Danielle DiMartino Booth was talking about that on her most recent Hedgeye interview, which just came out in the last 24 hours. Finally, we get into historical comparison here with the stock market rallying after it has already crashed. I like to look back at history because history doesn't always repeat, but it does rhyme. So after the October 1929 stock market crash, there was a bear market here for 7.5 years. It took that long for a rally for US stocks to rally enormously in 1937. However, things now in just the last couple months have been condensed because of that 20 trillion in central bank and government liquidity injection, and all those governments and all those central banks doing that liquidity injection. It looks to me like a lot of that liquidity came to the US stock market, came into US assets, US bonds, US stocks. And we've had our stock market rally here. It's obviously not based on fundamentals because there's not a lot of positive economic data. There's not really any positive economic data in the real economy. You have the CEOs making excuses that all the bad news, all the worst case scenario is all behind us. So we'll have to see. The question is then, are we right around there from a historical reference? Are we close to that February 1937 top there? And then after this bear market rally, are we going to go back into a bear market? Now, the central banks aren't going to give up. I called this rally in stocks. I was warning my patrons about this months ago. So while the stocks were still crashing in late February, early March, I was warning my patrons that there would be a stock market rally at some point because the central banks in the system we have now, especially the Fed, can get away with just injecting trillions and trillions of liquidity injections, especially with what we know really happened in 2008, the total number that a lot of people are not either aware of or they're denying that it happened. There's people like Jeffrey Snyder that are denying that $29 trillion in emergency liquidity injections were actually put into the system in 2008, 2009 to prevent collapse. And then Ron Paul later said that that currency and liquidity was taken out to prevent hyperinflation. I interviewed Ron Paul about this in the last year or two. Asked him point blank about the auditing the Fed and all that currency that was created. And he said after they bailed out for a while, then the Fed started pulling out those tens of trillions in liquidity injections. So they did put the currency in. If things get bad enough, they will put it in and then they will try to take it out so it doesn't cause hyperinflation, at least quickly. We don't know what's going to happen in the not too distant future with all these currencies, but they're trying to play games with putting these emergency liquidity injections in for, trillions, tens of trillions, and then trying to pull them out to prevent hyperinflation. Jim Rickards has said that the Fed thinks that they're dialing a thermometer, but really it's the temperature gauge on a nuclear power plant. It's an extremely dangerous game the Fed and these central banks are playing. Finally, we get to the last slide here, and this chart is about stagflation. So right now, a lot of people in the mainstream financial media are not talking about inflation, the possibility of inflation, but I've outlined that certain prices are starting to go up, whether that's food, beef, other prices. So if we do get stagflation from a historical reference standpoint, this is the type of stock market volatility we could have. Could have a lot of stagflation up and down, a lot of volatility, a lot of chop. So we'll see what happens, but I wanted to show some historical reference here with what happened after the October 1929 crash. How there was a stock market rally. It took a lot longer back then than the Fed and other central banks have financially engineered now, especially with the extra 1,200 stimulus checks and more people trading on Robinhood, in addition to all the other central bank intervention. But this chart shows what could happen or similar action if we do get a lot more inflation and stagflation in the real economy. So the bottom line here, to wrap things up, we now have research compiled in just a couple months that $20 trillion worth of emergency liquidity injections and fiscal stimulus, and stimulus, I'm using air quotes, really bailout, has been injected by governments in only a couple months to try to deal with the global pandemic, to try to paper over asset prices. But this has not solved the cash flow problem pervasive throughout all levels of society. Handing people one-time stimulus checks, giving small business owners a PPP loan that's only good for about 8 weeks, that does not permanently solve the cash flow problem to get us back to cash flows before the global pandemic. And that's one of the main problems. Myself and Danielle DiMartino Booth are talking about this. Not many other people are talking about this. That's one of the main problems right now. So even though asset prices were papered over, caused an enormous rally, in the real economy, the average Joe and Jane are not getting their cash flows that they need. Same thing with governments, same thing with small business, same thing with corporations.